The cool thing about the FHA program, FHA Back to Work, is that they can basically get a house 1 year after short sale.
If there's no lease.
Yeah. Well,
But they say no
let's
season,
clarify
no
that.
late.
Different is no season.
No season,
Yeah.
yeah.
But let's clarify that, okay? That's called the Back to Work program 1 year after the short sale. FHA Raw, we call it Raw, can do 1 day after short sale if not late.
Right.
Okay, so let me give you an example of the difference between these two. So the FHA Raw is you got a growing family, or you've got some type of documentation that will justify it. They're paying on time, so no defaults at all, and they're buying better. Okay, so how we define better is going to be in that letter of explanation. So the LOE is going to reference things like schools, neighborhood, or simply that you're going from, let's say, a 2-bedroom house where only mom and dad are living to a 4-bedroom house, and now you've got the in-laws coming in to help out with the baby that's being born. Okay, so one of my lenders that's really good about this is Build Mortgage for FHA Raw, because they like deals like this. FHA Back to Work 1 year after the short sale. The problem that everyone is having is when they're late. Okay.
Right.
So in my opinion, what's going on behind the scenes is that underwriters, how can you approve a deal? Because the normal rule is 2 years, right? 2 years of mortgage history. How can you approve a deal where the client was late? And remember, a lot of clients still have the impression that they have to be late to get a short sale. Okay, maybe it's true, depending on the circumstance, but that's what's out there. So what the best thing to do, and if you see a situation like this, is number one, if you can meet the documented hardship requirements. For example, it's not the fact that your client got divorced, but it's the fact that now half of the income is gone. That's household income.
Yeah.
Yeah, and then try to get rid of late payments. Okay, meaning like with our file, we noticed that he got hit multiple times. Try to get that consolidated or even removed if possible. Okay, what we were missing in our case was that the reason that they were late was not because they chose to be late, it was because the lender didn't take the payment.
Oh, that's that
Now,
one?
yeah, now we have something from the lender that says, "Dear Mr. Borrower, we are unfortunately going to take your payment because your loan promissory note says you have to live in the property and you do not." That's what we have. So it was basically the lender causing that. So the Back to Work program, I would first try to talk or build a relationship with a credit repair company, or just do a credit supplement, do an update, CBU update with the gurus. But this is a great opportunity because there's some people that want to buy, but they're kind of stuck in their house that's got just a little bit of equity. Like me. No, just kidding. But the other thing that's a really good niche besides this that I want you guys to also focus on is going back to your database. Okay, your database of people. As you know, home prices have gone up, and I'm seeing a lot of appraisers come in, as opposed to the big banks. So when it comes back to your database, you might want to think about converting your FHA customers to conventional. Yesterday I had a conversation with the client, and because of all these FHA rule changes, okay, they called customer service. Customer service said, "You're stuck with mortgage insurance forever." And they're like, "Rich, is that true? You told me 5 years." I'm like, well, it is 5 years. I don't know what it is. But I'm thinking to myself, well, if that's what they're saying, then that's more motivation for them to go conventional. Okay? Because some borrowers were stuck paying the mortgage insurance for 5 years if they're lucky, but they changed the rule to be 11 years. This is a long time. Remember, the average person stays in the house for 5 years. So it's a good opportunity to think about refinancing these FHA clients to conventional, especially because so far this year, I haven't heard yet, but mortgage insurance, as far as I know, is not tax deductible. I haven't seen that pass because I've been asking my tax advisors.
Not yet.
So because of this uncertainty, that giant $500 that they're paying every month is a waste of money. Last year, I justified it. I said, hey, you know what, don't worry, this is good. But the rules change on us. So you might want to think about that. Chris, I know you have a lot of streamlined files. Okay, imagine getting rid of the mortgage insurance. So I'm taking clients from 3.875 to 4.25. Well, why are they gonna pay a higher rate? Here's where the
Get rid of it,
complication
yeah.
comes in, we're getting rid of the MI.
That's right.
How do you calculate the cost of the MI? Because we know that this is actually a lot higher, right? When you add the MI to it. So what we can do is we can calculate the MI as an annual amount on how much they're paying and figure out the correlating interest rate. So I'm going to work with Zafai on a spreadsheet that I'll share with you guys to justify it. Because some clients will get it, and some clients will only see rate, and some clients, you know, will not just care, they just trust you and they'll say, oh, thank you for saving me money.
As long as they're saving money.
Yes,
And they can
that's-
see it, that's all
Yeah,
they care
exactly.
about. Yeah.
So sometimes they're technical, where they want to see what the cost is of the MI. Then you have to go back and figure out if they're in the MI from before, where it was 5 years, or MI from 11 years, you know, things like that. So basically, go back to your database because you'll encounter these people, and I will try to make it a system, make it so that you can store the interest rate in there so we can just alert you guys as soon as the rate drops or something changes. I'm trying to build all that, but basically, this is a good opportunity. Okay. The other thing that I'm encountering that you guys should be aware of is that people are now excited to spend money. You guys see that in the market? People are now investing in other places. They're coming back to that mentality of, hey, I'm safe now. Let me get some more things, you know, like a car or a house or a second house. So I've seen things like that. So one of the other niches that I want you to be aware of, because I'm encountering that, is the cash out guidelines. Okay. Do we all know what FHA maximum LTV for cash out is?
85.
Okay, it's 85. 85 because remember that if you're at 80, it's hard for me to sell the MI. Okay, so at 85 that makes sense. It used to be 90, you know, back when I started doing FHA, and it used to be 95. Now you can, now what's been happening too that I'm noticing a lot of is the seasoning on equity lines. So let's say they have an equity line that they got cashed out years ago. I've encountered some situations where if we use an FHA rate and term, we might be able to pay off this equity line and consider rate and term if they haven't had a cash out recently.
Mm-hmm.
Okay.
Within 12 months.
Remember when it got really, really tough in the old days, it was like if you had to cash out at any time during the loan, but now it's kind of loosening. Okay. The big banks are still stuck at the guidelines of this. This is the big banks. They say, okay, you have an equity line for $200,000. Whatever the payment is, I'm still going to hit you for a 1% payment. Okay?
You mean if you keep the equity line?
If you keep the equity line,
Yeah.
you just opened it last month, you didn't use it,
Yeah.
you're going to be stuck with that.
Right.
That is going to affect their ability to buy.
Right.
Okay? So in many cases, clients need to be aware of that if they do that, then even though it's not fair, that payment is going to affect their ability to buy an investment property. So it's important to understand all these different niches that are interacting. Okay, the cash out is going to give them cash to pay off their debts. A lot of people still have debt right now, and pretty much, you know, a lot of people are just in buying mode. Okay, and then the biggest niche that I always emphasize, because we're probably going to lose it, is I'm selling it differently now. Saying you buy a fourplex, you put down enough cash for one unit, so you leverage the other three. Okay, 25% down. Makes it really easy for the customer to understand. Okay, that's buying it as an investment property. So that's one of the biggest niches. What the big banks are doing, because I checked with them, is they're requiring landlord history, and when they're buying their future property, they're not giving them credit for the rent. So those are the guidelines that are coming down the pipe, but we can still do that as a broker. We can still do these type of niches. The other thing is manufactured homes, manufactured and modular homes. Okay, there's some pretty cool things you can do with it now. I mean, people are basically looking at land and having manufactured homes. And I think the manufacturers, like I met one because Mary did a deal. Mary Stunk, she did a deal that closed, and it was this nice solar manufactured home, and it's self-power generating. So I see a lot of that coming down the play in terms of, you know, real estate. So the ability to do these type of loans is good.
First Mortgage has a, because I just did their webinar on Friday. They have, if you go to First Mortgage's site, they have a whole, where you can
Do your own flyers?
Yeah, not your own flyers, but you can learn more about what they do.
Mhm.
So I guess they're the market leaders right now, manufacturers.
Are
Yeah.
those have to be double white platforms?
Yes,
Right, nothing but double white. 'Cause
nothing but
otherwise-
double white.
Yeah.
Yeah,
Yeah, this is based off the guidelines.
yeah.
Ex-
All double white.
expanded VA. Um, so this is basically a VA with no overlays. Anytime you see the word expand, it means no overlays, right? The biggest thing that I see when I sell VA is 100% LTV. And actually what's happened is even though it's zero down, those realtors, I mean, the listing agents, they love vets. So they're willing to take the offer, give it a chance, and then and then basically all you really have to worry about selling is the VA funding fee,
You can
but the seller can pay for that.
up the DTI to 60 because new plan
Yeah.
goes up to 60.
Yeah, but this probably means, again, it's bad English, manual underwrites to a certain
Yeah.
FICO score means max DTI 41.
Right.
Okay, so everybody
Just
understands that, right?
manual,
If
yeah.
it's a manual underwrite with a lower credit score,
Oh,
then it's 41.
Okay.
Open access, as we discussed. I think really what we're selling here is the fact that we have lenders that will have no overlays on max LTV and max LTV. All right. Really, if you think about it, one thing I wanted to do, if I had the budget, would be to create a site that simply let the borrower enter their information in, and then it just checks Fannie and Freddie to see if it's owned by Fannie and Freddie, and then all we do is run the system and see what it says. That's it. I haven't encountered this too recently. Have you guys encountered any upside down clients not in our area?
Not in our area?
Yeah.
Do we have that site already where you can determine if
Yeah, we
the
do.
loan is-
They're two separate links.
Yeah.
So I would have just combined the two.
Oh,
Because some borrowers have Fannie, some borrowers have Freddie, they
Yeah.
don't know what they have,
Mhm.
and it's not obvious. So, although we don't sell a lot of this is good for a conversation, with a realtor that can't quite get enough to sell the listing at 6% commission or whatever, and the client needs to do something, they care about the client, they want to help them out, but they don't know what to do. So that's basically the target. The jumbos. So basically, this is jumbos on one of our lenders. As Aflac can testify, we can do as low as 680, right? So our
When you
niche,
say one of our lenders, can you tell us which lenders?
these recent ones are all done with the Bank of California.
Okay.
And I won't try to put the source code on there, so you guys.
Oh, no. Well,
But the
you can
call-
tell us, but I mean, I wouldn't put it on here, but it would be good for me to
Yeah.
know, to get more information where I could go to, to.
Yeah, and that's why I had Marilyn send you guys those niches.
The niches.
So it correlates with these flyers. So this way you know what you're marketing. But our biggest niche against the big banks is the 30-year fix at a 680 credit score. Okay, I've had clients come in here, my credit score is not good enough. I say, what do you have? I have a 758. Wells Fargo wants me to have a 760.
Oh.
And I said, and he wants, to do credit repair. I said, for 2 points, you don't need to. So basically, this is a pretty good niche. Now, we are going to see a conglomeration of jumbo versus portfolio, okay, that phrase. So really, when it comes to jumbo, a jumbo product is a portfolio product. That means that they're lending you their own money, technically. There might be some investors behind the scenes like GMAC that actually is going to be funding them. But we're going to start to see more and more lenders start funding their own money. So it's going to be very, very exciting. So if the borrower wants an ARM, I'll be honest, I can't compete against them, against the big banks for the ARM product. I typically just tell them, hey, do you want to maybe rent it out in the future and have a nice 30-year fix? And that's basically my how I do those clients.
Why don't we don't want to sign up with US Bank? They've been beating ours up.
They have.
I could, as long as we're within our 2-lender. See, what's happening is we got all these lenders now coming into play, right? We've even had lenders coming visit us. So this month I want to get Parkside because they have a really good portfolio mutual fund product, which is very interesting. It's like a combination of conventional but cheaper than private money, cheaper than hard money.
An LTV up to.
LTV 70. So it's like a hedge fund product. So it's kind of a cool time.
Like stated?
Well, we can't say stated anymore because that's a
That's an old dirty
that's an ugly
word.
But we'll just say that they care more about the servicing of the property, the DSR,
Okay.
Commercial term, than the borrower. So the
Okay.
borrower can hold it
Got it,
LLC,
got it.